Welcome to the B.F. Anderson Techno Fundamental Report for September the 14th. Let's say you're a portfolio manager and you're with Fidelity Funds, which is between Fidelity, Vanguard, T. Rowe Price, so forth. We're talking trillions of dollars. So if you want to kind of observe the footprint of an institutional investor compared to us, you can see the dramatic difference. So let's say you're a portfolio manager, you wake up one morning and you go, we've been researching a company for a while. We're going to put 1% of our portfolio in there. Say he manages about $10 billion. Well, we both know that the name of the game here is to find something good and get there before the next guy. So it's a windy road and it's hard to find these opportunities, but we would recommend that you look at something called a volume signature, which we will look at here in a minute. Now, when you're going through the process of finding a market bottom, which I believe we're in the process of doing, and you're trying to find the next mega winners or the next big winners, or you're just trying to find the leadership of the market, it's kind of like a hound dog. You got to sniff them out. It's like making spaghetti. It's a process where you throw the spaghetti on the wall to see if it's ready and if it's Dante. In other words, it's like going into a dark room and you can't see where the switch is. So you have to really hunt and peck for these opportunities, and it takes time. So what we do, and I'll talk about this in a minute, is we do something called test buys. So it's kind of like you're drilling. Let's say you're on property, you have a lease, you're going to drill 10 oil wells. Well, if you start getting dry hole after dry hole after dry hole, you may have to abandon the project and move on to somewhere else. Well, this is where kind of diversification comes in. And in the book, The Battle for Investment Survival, Gerald Loeb talks quite a bit about diversification. He said it's a necessity for the beginner, admission of not knowing what to do and an effort to strike on average. Peter Lynch says there's no use diversifying into unknown companies just for the sake of diversity. A foolish diversity is the hobgoblin of small investors. That said, it isn't safe to own just one stock because in spite of your best efforts, the one you choose might be the victim of an unforeseen circumstance. Certainly been there before. In small portfolios, I'd be comfortable owning between 3 and 10 stocks. In other words, you want to focus. You want to focus on the winners. And so what we talk about is something called test buys. Here's an example of a test buy. This would have been back in 2003. Here's your volume signature. So this tells you that the big funds that we talked about here a minute ago are moving money into Apple in May of 2003. So you can see the gap up in the price and you can see the acceleration of the earnings. This would qualify as a test buy. So if we were in, favorable market conditions, we would probably take maybe a full position right away. However, if we were in difficult market positions, we might put about half of what we would normally do and do a test. And so if the market allows you to start making money on your investments, then that's telling you that you're back in a bull market. So that's really something you have to go through, because without the test buys, you just really don't know. So I wanted to go back and point out that in 2000, 2009, this is the S&P 500. You can see what the bottoming process looks like. The market made a low and then went into an uptrend. Well, this is where we are today. This is last October. We've made a low, and now we're in an uptrend. So the primary trend is up. It's just that we're getting corrections and pullbacks like we are today. So if you look at the big fear out there, the big fear is that we're going to have some deep recession. Well, if you look at things like the Chicago Fed's National Financial Conditions Index, you can see that back during recessions, which are the shaded areas, this is what it looks like. You get a massive up move, then a breakdown, up move, then a breakdown, an up move, then a breakdown. We're not doing any of that right now. So, if you take this a day at a time, you realize that there just isn't a recession today. Maybe it's coming. Now, I wanted to point out some important numbers here. Here's the new highs on the S&P. You can see here we're just not getting any. a very sideways trading range type of market right now. The problem again is interest rates. Look at these mortgage rates; they're up to right at 7%. So the mortgage market is getting really hit pretty hard here, and home buyers are having a tough time. Here's the power index, which we're getting a somewhat negative reading on here. It's basically telling us that for the last 125 days, interest rates have been primarily moving up. So with inflation, higher interest rates, this is the culprit, this is the problem. Small cap stocks have really got me worried here until I see some type of improvement in the small cap index, which is the S&P 600. I would say you should stay cautious here. The breakdown in the small caps is just not a good sign, and we need to keep an eye on this index. Now, as I said earlier, though, the 200-day moving average is in an uptrend, so the primary trend is up. We're just dealing with a short-term correction, we hope, but sometimes corrections turn into bear markets. But we're watching closely. I would keep a high level of cash right now. I would honor your stop losses. Just be aware that we're in a kind of a difficult market here. The other problem is the price of oil. Price of oil has gone back into an uptrend. You can see here on the trend meter, we're back in the green. In fact, this morning, West Texas hit $90 a barrel this morning. So prices of oil are contributing to the inflation problem. However, on the growth stocks versus the consumer staples, we're continuing to see the aggression index actually moving out of above these moving average, looking strong. So actually there are positive signs out there. It's just I'm concerned about the small caps. I'm concerned about interest rates. Here are the three economic indicators. Here's your interest rates again. You can see they've moved up, somewhat elevated. Price of oil moving up. Financial stocks pretty much moving sideways. Other bad news here for me is the number of new lows on the New York Stock Exchange. So we're not getting any new highs, and we're getting way too many new lows. So again, continues to be a warning. Now, I wanted to mention Apple here real quick. We had shown it as a test buy back in 2003. The stock has really been breaking down. And the only reason I've really got to factor this in is the company just really isn't growing anymore. So just be aware of the fact that Apple's somewhat gone into a downtrend. You can see here on the trend indicator that things are kind of going negative here. So if you have any questions, please give me a call. Thank you very much.